Gentlemen, I'm going to call this meeting of the Budget Committee to order on January 12th, 2017. We'll start with Pledge of Allegiance to the flag.
I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all.
Madam Secretary, if you take roll, I would appreciate it.
Mr. Souza?
Here.
Mr. Edwards?
Present.
Ms. Hollenbach?
Present.
Ms. Rashley?
Here. Present.
Mr. McNally?
Here.
Mr. Leonard?
Present.
Ms. Janik is present. Mrs. Driggs? Present. Mrs. Cook?
Here.
Mr. Katz?
Present.
And Mr. Karen?
Here.
All right, thank you. And I would remind everybody on behalf of our video recorder that when you use the microphone, speak directly into it because the mics are very directionally sensitive. What I would like to do is ask if anybody from the public, because we've added an item to the agenda where we're going to have an open public forum for comments or questions about town finances or budgets. Each speaker would be limited to 3 minutes, give or take. So I will ask if anybody from the public has a comment. Seeing none,
It's up there, though, I think. Thank you.
what I'll ask for next is that somebody make a motion that we move the review of minutes until after our guests make their presentations.
So moved. Second.
Any discussion? All in favor?
Aye.
Unanimous. Okay. And with that, I don't see our town administrator here. We do have both representatives of the investment management group and the actuarial. So I'll fill in with just a very brief overview of the police pension. It's a separate pension system. All the other employees in the town have their pensions through the state system. Excuse me, that's not true. I just made a mistake. There's one other group. The people at DPW have their pensions through the Teamsters Union. The police have their own local pension fund. All the other people in town have their pensions through the state system. The police pension fund has a board of trustees. The town administrator leads that trustees group, has a treasurer, the chief of police, the president of the police union, and at one time, the town clerk was on that board of trustees. I'm not sure that's true. And then the council has a representative. That group hires, number one, an actuarial firm to provide that information, and they also hire a group of investment managers. What I would like to do is start with Mr. Brown to give a little bit of an overview on the actuarial report, in which all of you should have a copy thereof, I hope. And welcome, Mr. Brown.
Thank you. Good
And
evening.
thank you for coming.
So, we had previously done a complete actuarial study as of July 1, 2016, and an actuarial study is done each and every year as of the first day of each plan year. So we were not scheduled to do another complete study until this coming July. I was at the most recent pension committee meeting last week, and they asked that I appear today to talk to the budget committee and present some revised figures based on some recommended changes. I will tell you that we didn't have sufficient time to do a complete, thorough actuarial study, so I have made some we've made some estimated changes or estimated calculations as to the net effect of those proposed changes to the actuarial assumptions and plan definitions, and I'll get into that. So the complete study that was done last July, and I might add that if you asked us to pick the worst month to ever do a study, it was last July, so if you can later see the results from Washington Trust where they track the value of the fund month by month by month, and the lowest point at any time in 2016 was June 30, 2016. But we don't get to pick the date we use for the valuation, we use the plan year. So, and I've just given an excerpt of the actuarial study here and shown what the ARC is and other critical numbers for 2016. So the ARC stands for the annual recommended contribution to the plan, and we're talking only from the perspective of what the town's contribution is. I have a footnote just to indicate that the membership, the police officers, do contribute 10% of their pay, which last year was $168,629. So I just wanted to make it clear that the ARC of $559,740 only represented the town portion and did not reflect what the officers themselves need to contribute. I will just mention parenthetically that last year's total contributions were slightly less than the total outgo from the plan, and if you look at the recap from Washington Trust to see the net cash flows in terms of additions and distributions, that's a net figure, meaning that more went out than went in. So the ARC was recommended to be $559,000, which represents the cost of funding benefits earned this year and the cost of amortizing the unfunded liability, meaning the shortfall between the value of benefits and the assets on hand. So we're anticipated to make $809,522 of benefit payments for the 16-17 plan year. The assets on July 1 were $9,556,000 and change, and the accrued liability, which is the actuarial value of the benefits that have been earned as of July 1, was $15,266,000 and change. The difference between those represents the unfunded liability, which I indicated is amortized over what we refer to as a 25-year closed amortization period. So we started with a new amortization schedule 3 or 4 years ago, according to the FIP, or the Funding Improvement Plan. And the unfunded liability is amortized over the remaining period of that 25-year period. And we show that the funded ratio as of the beginning of 16 was 62.6%. Now, we have two issues which have caused us to provide an adjusted ARC. One is that given GASB, which is the Government Accounting Standard Board, there have been some recent changes to GASB, and they are recommending that a more current mortality table be used. And so we were planning on using a more current mortality table for the 7/1 17 actuarial valuation. We're using what's known as an RP 2000 scale, which essentially is using a 2000 mortality table, and would propose to use an RP 2014 blue-collar mortality table, much more current, 14 years newer, if you will, and projecting that with using a 2015 generational projection. So the government has a table that's created in 14, and then you can project it forward for improved mortality for 15, 16, whatever. And that mortality table now will change on an annual basis. I might add that in the private sector, that's what happens for funding purposes. And we had done a rough estimate last fall when this issue arose, and we had made recommendations that we consider a more current mortality table, and at that time, it was estimated that the accrued liabilities would increase by about 5%, and it would increase the ARC, or the annual recommended contribution, by about 13%. Also subsequent to 7/1/16, it came to our attention that the contract with the officers, and it wasn't yet incorporated into the plan document language, but the contract with the officers called for holiday pay to be included in the definition of compensation once the funding threshold or funded status exceeded 60%. And that happened last year. And so holiday pay should now be included in the definition of compensation, which is going to mean higher compensation that would be used in determining benefits for the officers. I might add that overtime is not included in the definition of compensation. It's only base pay. So by including holiday pay in the definition of compensation, that would again have approximately a 5%, call for about a 5% increase in the value of the accrued liabilities, and correspondingly a 13% increase in the ARC.
Could
So-
I just ask one quick question?
By all
I'm
means.
sorry to interrupt you.
No,
You just said,
I'm just
yeah.
free
You
associating.
said currently the base pay is just compensation, but it looks like
No.
it also is longevity and incentive earnings.
I didn't say it was just compensation. I
thought
said that the definition of comp does include,
Longevity
I think it does include
and
longevity.
incentive earnings.
I believe that's the case. I didn't bring it.
And now
but-
we're adding holiday
But
pay.
we are, it doesn't include overtime, and it doesn't include holiday pay. And so the holiday pay now needs to be included in the definition of compensation, and that is going to have an impact by increasing the overall liabilities.
So if I could follow up, since the inclusion of holiday pay was triggered by the funded ratio going over 62%, now that the funded ratio is less than 62%, I'm assuming that the holiday pay stays in forever.
My understanding in talking with legal counsel for the town, that is the case. So once you pass, now we had changed the actuarial assumptions for interest back a few years ago when we were required to submit a FIP. We were using 7. Many of the other cities and towns were using 8%, so those plans looked a little healthier than they were, and ours looked a little bit unhealthier, if you will, when compared with other cities and towns. They came down to 7.5% to make things look more reasonable, and for the town to be on the same footing if they were being compared with Coventry or Barrington or whatever other cities and towns had private plans, the decision was made to move the interest assumption from 7 to 7.5. That made the funding status look better, but, and we weren't aware of this provision in the collective bargaining agreement that the definition of holiday pay would that holiday pay would be included in the definition of compensation, yes.
I just had one other question. You indicated that, so there's a 13% increase adding the holiday pay.
In the ARC, just.
In the ARC, and there's a 5% an additional
it's-
5% because of the mortality table
No,
being
Well,
changed?
so there's two items that I addressed in terms of their increase. So for both the change in mortality and holiday pay, we're anticipating a 5% increase in the accrued liability, which translates to a higher unfunded liability, which translates for each of those changes in assumptions about a 13% increase in the ARC. So in the aggregate, it's about a 26% increase in the ARC that we're going to experience. We will have more hard and fast numbers when we have time to do a complete study
Because
as
I'm
of
looking
July
at,
1.
like, the hugest number of people who are getting pensions are 45 to 49. They're going to be around a while.
They
Yeah,
They
that's true. Because
may likely be that.
keep in mind that the length of service is 20, and now 25 years.
Yeah.
So if
So the-
a
yeah, the
young
20
person joins the police force at 21, they can theoretically retire at 41.
Well, the new hires will have 25 years
Yeah.
for full
So
benefit.
now they will be 46.
Yes.
And since, look at longevity, so yes, they're going to be around a long time. The other thing that's interesting is that we have 26 retirees, and I think right now we have 29 active duty police officers. So we're just about 1 for 1.
Well, theoretically, the benefits for those officers have been funded, but in actuality, they haven't in terms of the retirees, because we have this shortfall, and as I had pointed out at the outset of my presentation, the total contributions between the town and the officers is less than the total outgo for retirement benefit payments. So I've reflected here in the second row that the estimated 2016 numbers with the increase in the ARC, and then that was developed from the increase in the accrued liability and the unfunded liability, and projecting a funded status of 56.9%. Now, this will be impacted by the investment return. We have to look at the assets. And as I indicated before, the assets were at their lowest point at any time in 2016 for the date that we were required to use for the valuation. So hopefully, things will look a little bit better.
Well, but we use the same period every year, right?
Absolutely.
So,
We're not.
so
we're
the
not-
seasonal adjustment shouldn't make
We're
a-
not forum shopping, but I was just pointing out that, the assets are going to vary during the course of the year, and it just so happened that was the worst time to do a valuation. We have no choice, but I'll leave it to Washington Trust to make their presentation, but, hopefully the assets have performed better, but, they can't make gold out of straw. It's only going to be according to what's happening in the marketplace.
Yeah, I have a housekeeping question. We all have your report dated August 31st,
Right.
2016.
Right, that was
And
the-
one page that you handed out.
All right, so where does
is
that
this-
fit in?
No, I just want to make sure this one page is a supplement to the August 31st
It is,
report.
and so actually what I did is that if you saw this on page 4, there was an expanded schedule of anticipated,
Yes.
the anticipated ARC, assuming a 7.5% rate of return. All I did, because we didn't have time to do much more, given the short notice we had, was I excerpted the 2016 line here, and then I adjusted it for the anticipated changes of the change in mortality and the new definition of compensation where we need to incorporate
Yep,
holiday pay.
okay. Does any other committee member have questions for
Yeah,
Mr.
well,
Brown?
first, I want to make to make, for the record, make it clear that there is no ambiguity. The contract is explicit that as soon, if it ever falls below 60, after it's gone over 60% funded, they will continue getting holiday pay. And since it was over 60 when they signed the contract, it was kind of a useless, silly political language to put in there. I do have a question. Do you have any sense of the average mortality age that we're looking at? Because, I went to the tables advised in the actuarial report, and, to a non-actuary, they're just a lot of numbers.
What's the assumed longevity for anyone? I can't tell you specifically. They're all in a table, and I don't.
I don't see it.
Do you have any sense of?
Oh, okay.
Is it ever at any
Is
point
it
calculated to have some kind of an estimate?
Is it equal to the average American male?
Well, we're proposing using a 2014 blue-collar mortality table, which is a little bit less favorable than, an average mortality table. It's just because
Dangerous work.
for, police officers, firemen, that is what is more typically used for actuarial assumptions.
Yeah,
So-
I just want to ask a question to Mr. Katz. Were you asking what's the average age of death for the pension people, or were you?
Yes,
Yeah, okay.
I can try and get that number.
Okay.
But
Do you have a guess, like ballpark?
no, I won't guess.
Okay.
Oh, no. Asking an actuarial person to guess
Well,
is never going to work.
So,
Never.
but I can communicate that to the town administrator and the treasurer, and
Yep,
they can pass that information on,
Yep.
but I won't hazard a
I
guess.
understand. Anybody else have any questions?
Question, and I'm not sure if Mr. Brown, this is within your bailiwick, but there's a funding improvement plan that has recommended a $700,000 a year contribution.
So the funding improvement plan, the idea was that the arc would be met, and initially, the town had said, we're going to put away X. And I think that number at one time was 8 or 850, and then it was revised to 7.
But it's
So-
over
but the-
what's
but the FIP
required.
The FIP didn't necessarily call for a $700,000 contribution.
Right.
But the town had offered that this is what we intend to do.
But it's my understanding it was significantly less that we could have done.
Could have, yes.
Yeah.
But, what I want to express is that, I guess we're so used to looking at numbers and giving certain credence to that. Appreciate that when an actuarial study is done, this is someone's best guesstimate using generally accepted and approved principles of coming up with some type of gauge as to the financial health of the plan. In reality, you never know what a plan costs until you've paid everybody out. Of course, that's not going to happen because this is an ongoing plan. So we try and use assumptions for mortality and turnover and investment return that are reasonable. So it's the way that people gauge the health of these plans, but it just, you could be 100% funded and still be in trouble, or you might not be in trouble. It depends on it's someone's best guess as to the mortality of the group, which may be much better than what we're assuming, or worse, so.
Any other questions?
A procedural question. Who in this process would be responsible for advising our pension board on an advisable discount rate? Would that be actuarial or investing?
Well, that's a very good question. We would use a rate that you want us to use, providing that the investment advisors feel that that is a justifiable rate. So when we went from 7 to 7.5, you know, his question, is that justifiable? You know, and if you want to use something, and I would say in today's environment, using something higher probably would not at all be recommended. Appreciate that, and one thing I didn't address in this Reader's Digest version recap, but there's also something called the salary scale, which is the presumption that salaries increase at 3.5%. Now, salaries aren't going up at 3.5%, you know, and the president of the union said, well, salaries aren't going up at 3.5%. And I says, and the fund's not making 7.5% either. So the salary scale and the interest assumption kind of go in lockstep with one another. So although we're assuming 7.5% and the plan hasn't achieved that level for a couple of years because the market isn't there. You know, the market isn't there. We're also assuming a 3.5% salary scale, and that's not happening either.
Does that capture?
So they kind of
increases,
offset,
or-
they kind of offset one another.
Does the salary scale, 3.5, does that capture, say, step increases or rank increases? Or-
It assumes that salaries are going up at 3.5% a year.
So an individual person, whether it's because of steps or an overall raise, 3.5 is the
Yeah.
assumption. And that's not.
Which may not be unreasonable, but if it's a little bit higher than reality, then that just tempers the, you know, having a higher interest assumption. But we would use what you ask us to. I mean, we would come back and say, you know, that's not reasonable. So 7.5, you know, that's fine. I wouldn't go higher than 7.5.
Are you talking about
today's environment.
7.5% return on investment, basically?
Well,
Is
that's
that what we're talking about?
that's what the discount rate is. It's your assumed rate of return.
Inclusive of
But-
inflation.
Doesn't it partly tie into sort of the equity risk return you can get depending where else investors could put their money?
Sure, and
So you look at
so that's
things
more of a
like-
question for the investment folks. But
Okay. I mean, you look at articles now, they're thinking with not even getting 2% for debt, you're talking about maybe 6% for equities, and we're up there at 7.5. I don't get it.
yeah,
Yeah,
well,
the-
I
the-
think part of it may be a political issue, candidly, that if all the other towns are using 7.5 and you were to use 7 or 6.5, you know, and you're being compared with the other towns, they might say, well, what's going on with the Tiverton plan? They're not looking too healthy.
Your unfunded liability, if you were down at 4%, it would go from
It would-
60% to 40% funded.
Yes.
So suddenly you have to admit that you're in an economic crisis. which-
That's
You're in a
correct.
which
critical,
we
you're
governments
in
don't
a
wanna
critical
do.
situation.
That's correct.
So,
And
But-
to your point, I happen to be looking at the equity breakout, and there is quite a bit in equities here.
80%.
80%.
yeah.
But we're going to let the investment people address
So I
that.
understand.
Yeah,
I understand.
but, I mean, it,
Okay.
we changed the actuarial assumptions, not because we recommended it, but it was something that was requested by the town, and providing that was supportable by the investment folks, then that's what they would do. So our actuary would say, let's hear from the investment folks whether that's a supportable number, and then we'll use it. Other things that we came forward to say we should use a more current mortality table because of the recent changes in Gatsby. Are there any other questions?
Any others? Hearing none, we will thank you very much for coming and sharing with us this evening.
Okay, thank you.
And if you do, let the treasurer know what your research yields as far as the
What the
Average,
average mortality, average life expectancy might
Yep.
be. Of course, that depends on what age we're starting at, you know.
Yeah.
If you're looking at a 45-year-old, their life expectancy is X. If you're looking at a retiree who's 65 years old, you know, since they've already made it to 65, you know, their life expectancy
Yeah.
will be.
But you're also
what-
talking
little bit
about
longer.
police and guns.
What
and
Mr.
Yeah.
Katz wants to know is, on average, what is the age
Yeah,
of
I
the
mean,
gentleman when he dies?
If it were easy, I wouldn't mind a table that actually gave the ages by age. But lower than that, I'd kind of like to know the average for the
Sure.
beneficiaries and the average for the active.
All right, yeah, and many of these officers have chosen a joint and survivor annuity as a normal form of, or as a form of distribution, so they've protected their spouses with a retirement benefit.
Okay,
So-
again, thank you very much.
So
We
you won't need me
appreciate it.
again, I can
Yep,
head off. Okay. Thank you, and a happy, healthy year to all.
thank you.
Thank you.
And now we will call our investment managers up, Ms. Kane and Mr. McCabe. And they have handed out a nice exhibit. Which they will go over.
Okay, so my name's Joan Kane. My colleague Jean McCabe is with us here today. We started managing the pension plan, I think it was in March of 2014, so it's, been just under, three years, relatively short time period. And we've been told we have about 20 minutes, 15 to 20 minutes. So what we'd like to do is cover the book presentation in front of you is put together in 3 different sections. So the first part just talks about what's happened in the market, in the stock market and the fixed income market for 2016, which is somewhat instructive and helpful when we go through your portfolio. It's about a $10 million portfolio today. It does have a healthy allocation to equities, 80% equities and 20% bonds. The reason for that is because of the funded status. So on average, over very long periods of time, bonds will generally earn you the coupon rate, somewhere between 3 and 4%. Stocks, somewhere between 7, 8, maybe 9%, depending upon the time period you're looking at. Because it was so underfunded, when we took it over, you really had to have that allocation to the equity market to make that up. So that's the background with that, and we can get into more detail and take your questions when we get to that second tab. But I'm going to turn it over to Jean for just a few minutes to give a high-level overview of what's happened in the marketplace, and please interrupt us with any questions as we're going along.
Great, thank you, Joan. And that 80-20 allocation also requires a bit of confidence or faith going forward. And some of that is, you can look at the exhibits in this booklet. Page 2, for instance, shows you the track record of the U.S. economy, GDP growth, and the forecast for GDP growth going forward in the chart there. And it's all around 2% growth. In the absence of a recession, you'd expect the stock market to continue to advance, which would favor stocks within your allocation. If you flip to page 3 in our dashboard, the 2 columns down the center, short-term and long-term trends in each of the areas indicated on the left. Statistics are released each week. We monitor the releases. And really kind of all signs are go for the economy. And this has been the case for several years. This dashboard has been basically a confidence builder in the U.S. economy if you study it. The only weaker area is industrial production. It's difficult to be a manufacturer in this day and age, but otherwise, employment trends, basically everything has been in the favor of the economy continuing to grow. So we do not see a recession looming in the U.S. If you come to page 4 in our fixed income outlook, our bond portfolio outlook, the shaded blue squares are kind of historical norms for interest rates. If you were to buy a 3-year treasury or a 10-year treasury or 10-year treasury, you might get 4.7% if you bought a 10-year government bond. Today, it's more like 2.5%, and it's trending higher. Finally, since the Great Recession, interest rates have been so low, finally moving higher. When they move higher, you do poorly in bonds. You wouldn't want to have a lot of bonds in your portfolio at such a time. We're at such a time. So, again, getting to 80-20 is a combination of factors. And last, I'll bring you to page 6. Our stock market outlook. Each column there represents a calendar year, and the S&P 500 earnings for that year, $113 per share in 2014. The estimate for 2017 is $132 per share. Typically, the market will trade at a multiple of earnings. A normalized kind of multiple might be 15 to 18 times earnings. And if you do the math, 132 times 15 is 1980. You might expect the S&P to trade as low as 1980 and as high as 2376, and consider that a fair market range. What I think we've seen since the election and the rally that we've seen in stocks has maybe been kind of getting ahead of itself, the market, and trading into this year's expected growth in earnings. So at 22.39, which is where the S&P 500 is currently, doesn't give us a whole lot of upside, even though we are comfortable with a 10% increase in earnings. But we do see upside. And then, again, we don't see a recession, and maybe when you make a case for 2018 earnings, you can continue to build on 17. So our outlook for bonds is not great, given a rising interest rate environment. Our outlook for stocks is muted because we've had this recent rally. The S&P was up about 12% in 2016. We expected more like 7 or 8%. We probably expect 7 or 8% in 2017 for stocks as well. And the last thing I'd bring to your attention, I'll hand it back to Joan. On page 18, you can just see the scheme of how each asset class worked during 2016. To the left of the page are stock market-related indexes, and to the right are bond market-related. Far left, the dividend area of the market. Again, that low interest rate environment has encouraged people to leave bonds.
Excuse me, 8 or 18?
I'm sorry, page 8.
Yep,
Excuse me.
that's why we were looking confused.
So the bar chart on page 8 shows stock indexes on the left and bond indexes on the right. Among the stock indexes, dividends did the best, up 22%. Dividend kind of paying stocks, as opposed to growth stocks. Over on the right, you see our growth strategy up 3%. Not a lot of dividends from growth companies. They're plowing their earnings back into their expansion. Investors have been very hungry for dividends because interest rates have been so low. As I said, that tide has shifted. Growth is coming into favor. If we look at the first 2 weeks of January, this really is reversed. The growth end of the market is the winner. The S&P is in the middle. The dividend is down a bit. You can see small cap and mid cap stocks did very well. A big kick after the election. They benefit from some of the policies contemplated with a new president. They're not hurt by the rising dollar, which again is affected by rising interest rates. So again, this is what's going on. It's subject to change. It constantly changes, but it looks to us like bonds are going to be difficult as rates rise, and stocks maybe have gotten a bit ahead of themselves. So we're looking for mid to high single-digit returns from the stock market in 2017.
Yeah, and I'll just say that, these returns, 22% and 21%, aren't sustainable. So what we've started to see, and Jean pointed out, is sort of an inflection point, and growth is coming back into favor. So, and we'll see that in your portfolio. So your portfolio really is more of a growth-oriented portfolio, not a high-octane growth portfolio, but growth at a reasonable price versus a dividend strategy. So your portfolio outperformed in 2015, 2016, it lagged, and now we're seeing it turn around again. So it's a mirror image. So let's go to the account detail tab. And I'm on page 9. And the pie chart on the top right shows you that the portfolio is allocated 80% to stocks. That's our growth strategy. And 42% of that is indexed as well. So it's an active index blend, which was what we recommended back in 2014 and what the pension committee approved and ratified. And then you can see about 20% or so is in fixed income. And there is, you can see on the top left, there is a net contribution and withdrawal, a negative value of $7,000. So that means there is more coming out of the plan than there is going into the plan. That has nothing to do with returns, that's just contributions and withdrawals, the nature of the liability stream in the portfolio. And about $63,000 comes out every month. So the total amount on an annual basis is over $700,000 for distributions. And I'm sure that's all in Jeff's actuarial report as well. Okay, so the strategy behind growth is, over the long term, we have 2 proprietary strategies, as Jean pointed out. Over the long term, growth should outperform, the big, large, blue chip, dividend-paying type companies. But there are times when dividend is in favor, and that happened to be the case this year, particularly your fiscal year. So if you go to the next page.
Before you move on, could
Yep.
you just explain a little bit better, a little bit more, in case I missed what you said? Unrealized gains, what is that? Do you know?
So that's the case where, say, a particular stock increases in price, but we haven't sold it or had any transaction activity, so it's run up in price.
Okay, so that's not counted in the value of the assets, or it is counted?
Yes, it is. Mm-hmm. Yep.
Okay. Right, thank you.
Okay. I can show you some more detail in our asset review, so it might make sense in just a few minutes. So if you look at page 10, I'll focus your attention on the top right-hand side. This just shows you the top 10 holdings. The first two holdings, S&P 500 ETF, so that's an index fund. It's not actively managed, it's passive. We have a mid-cap exposure also of 17%. Russell 2000, which did very well this year, of about 5%. And then further down, we have another mid-cap allocation of 2%. So the total index exposure in the equity portfolio is about 42%. And the rest of it is our individual growth stocks. On the bottom left-hand side, you can see industry sectors. And Washington Trust has historically overweighted those growth areas, information technology and healthcare. And then our financials are up more than usual at about 6%, and that's primarily because investors have a lot of faith and confidence that the banks will do better because interest rates are going higher. So when interest rates go up, they earn a larger profit margin. Net interest margin is what it's called. But you can see it's fairly well diversified by individual holding, aside from the indices, and by industry sector.
What does the top?
Not applicable?
Yeah, what's that?
So that's
half the.
Right, so that's the index funds. So the model, or this particular module that we use, can't drill down in the index funds for the industry sector. That's why. So that's the 17% S&P 500 and the mid cap and the small cap. Okay. On the next page, just high-level overview of the fixed income portfolio. The bulk of the fixed income portfolio is in mutual funds. There are a handful of individual bonds, but it's basically very high quality, very liquid bond fund. The top left-hand side, you can see some of the averages. It's a very short duration portfolio. You know, maturity is about 5.6. And the actual duration, which factors in if a bond can be called or not, so it might be called before its maturity date, is about 5. So that's relatively short. And you can see high quality A2, where it says S&P and Fitch. Those are, we really rely more on Moody's than S&P and Fitch. Okay. High quality, very liquid. If you turn to page 13, this is our asset review, and you can see the individual stock holdings, and they're arrayed by industry. Okay, and all of our clients own all the same stocks. What differs in terms of portfolios is how they're allocated among various asset classes. So when we decide to, and Jean sits on the growth committee, when we decide to buy a particular stock, let's say Amazon, for instance, it's bought, the committee recommends it, it's bought for all of our clients, okay? So your portfolio looks the same as all of our other clients. And if you go to page 16, I'll go through all the details of all the stocks given our time period. So page 16, you can see the mutual fund fixed income. Those are the fixed income bond funds that we own. And then you can see the unrealized gain or loss that you had asked about. It's the fourth column from the right-hand side. So since inception, since we began managing the portfolio in March of 2014, the unrealized gain is $957,000. And this is all as of year end, and the portfolio value as of December 31st was $10.5 million. Questions on the asset?
Yeah, I want to make sure that I'm understanding the unrealized gain. So
Yeah.
we have 957,000 of unrealized gains. So you have not sold those securities.
Right. So that's
The
just
market value has gone up,
appreciate.
which you mark your asset value to that market
Right.
value, but you haven't sold it and put the money in your pocket.
Right, so for instance, on page 13, we look at Amazon, you can see the total cost when we bought the stock was $68,000. Do you see that?
Yeah.
Okay. The market value as of December 31st had gone up to $138,000. So the difference there is $70,000.
So what you need to do as investment managers is sell that Amazon, find the next Amazon.
Right, exactly.
As quickly as
Right.
possible.
That's right,
Is
yeah.
there a suggestion box in the room anywhere?
That's right. Yeah,
You
no, that's been a
mentioned-
good one.
You
figure
mentioned a
out-
committee, is that within Washington Trust?
Yeah.
And how often does the committee meet?
Once or twice a week.
Yeah, and there are
Every
two,
Tuesday morning for about 3 hours, and then if there's another meeting required, a second meeting.
What kind of turnover generally is there? Not too much?
On the committee or?
Yeah,
in the-
no, in
On the staff?
in the actions of the
Depends on
committee.
the
There-
results.
There's not much. We're pretty tax sensitive. It doesn't apply to an account like yours, but we do have individual investors. We try to be long-term investors. We buy something when we think it's going to do well for 3 years. So we might turn over a third of the portfolio in a given year, which isn't really high compared with a lot of mutual funds.
let's see, in 2000, on a calendar year, you guys are fiscal year, but on a calendar year, we added 7 stocks, and we deleted 7 stocks, so.
I had a question. Is it not standard to put the realized gain loss in this format?
The realized,
Yeah, so when you sell it, then you know what you've actually made.
that gets factored into
I think you
the
see
returns.
it on page 9.
Okay.
And it also gets factored into the returns, which we'll get to in just a minute. Page 9?
On page 9, that upper left side,
Oh.
for the calendar year ended 12/31, realized gains actually worked out to be a loss of $79,000 on a
Okay.
net basis.
Mhm.
But that's the figure for that year.
Thank you.
Yeah, and one of the challenges with something like a pension plan, for instance, that has cash flow needs, there's constantly money coming in and money coming out, 63,000 or so. We don't always have the luxury of timing, so, we'll have to do some liquidating on a regular basis, and, sometimes it's not a great time to be doing that. So the cash flow requirements do affect the return profile as well.
Thank you.
So the realized gains or losses would be the difference of what you paid for the stock and what you sold it for?
Right.
So during this fiscal year, the stock that was sold ultimately had an overall loss of about $80,000.
Yeah,
Not fiscal year, though, but calendar year. yes.
calendar, right.
Okay, yeah.
Yeah, that's a calendar year basis.
Related to what I heard a minute ago, this portfolio is 80/20, and that's fine. And it's a growth-oriented portfolio, as opposed to, say, a yield-oriented. So what, are you, did I hear that you have to meet with the board of the pension fund if you all of a sudden decided, hey, market conditions have changed, we want to go more into dividend stocks, like we want to go 60% into dividend stocks and not growth? Does that require, is that an act of Congress? Because you have to go through the pension board and almost redefine the definition of this? Or you said when you came on board 3 years ago in 2014, there was a decision made to make this growth-oriented to try to catch up. I'm just wondering, if a nuclear bomb hit and you wanted to go to cash, could you?
Yeah, so our mandate the overall mandate is 80% stocks, 20% bonds, and we have discretion to make those decisions as we see necessary. So we do meet with the pension committee face-to-face twice a year, and then there are 2 other meetings, they meet quarterly, 2 other meetings that we don't attend, but we provide them with a summary. And I guess the other factor that we all should remember is there's a healthy allocation to the index funds, to S&P 500 and mid-cap, which does have a little bit more of a yield allocation orientation. Did I answer your question?
Well, I guess so. If you, in your meetings twice a week, if after a few meetings or weeks or whatever, you wanted to shift more into dividend stocks for some reason, whatever it may be, is the fact that this is all oriented in or biased toward growth right now, do you have that latitude to shift, say, into dividend stocks, or do you have to clear that with the pension board that you've shifted the angle?
We do have that latitude. do
Okay,
have
so
that
it's the 80/20 more that's locked in.
Right, that's exactly right.
Okay.
And there is some overlap between our two strategies, so I think there are maybe 8 stocks that are in both the growth portfolio
Right.
and a dividend
Of course.
portfolio. Again, all very highly liquid. And so sometimes the dividend's gonna work in your favor. For instance, in 2016, dividends did very well. 2015, growth did well. Now we're flip-flopping. So we try not to time it and play that game so much.
Too much,
Just make
yeah.
sure we have a very diversified portfolio that has the benefits of both, plus the index component.
Thank you.
I heard you, I think I heard you say that you get a mandate from the Pension Retirement
Yeah.
Board, and they're the ones who tell you what between stocks and bonds, that
Right.
kind of thing.
Yep, the overall asset allocation, right?
This may sound like a dumb question, but who is the retirement? They're not part of Washington Trust then?
No, that was the group that I outlined before I introduced Mr. Brown.
Okay.
Right, so the
Town and-
pension.
So they're
Town
sort of
administrator.
imposing upon you their overall sense of equities versus
We made
bonds.
recommendations to them.
Okay.
So, and, backed it up with, rationale and history, and the funded status really is what drove that overall asset allocation. And it has
Okay.
worked in your favor, and it will
Yeah.
continue to work in
Okay.
your favor, particularly the next few years, because as Jean pointed out, a rising interest rate environment is not favorable for bonds. So, and you'll see that when we get to December 31 performance numbers for you.
So then within that mandate, 80% equities, that's where your committee twice a week, that's where you decide what kind of equities.
Right,
Okay.
yeah, exactly.
When you say it worked in our favor, what do you mean by that?
The overall asset allocation, stocks versus bonds. Stocks have done better than bonds.
Okay,
during the-
so it's with reference to what it would have been if it were a different allocation, but not with reference to meeting our discount rate or anything like that?
Right, right,
Okay,
right. Comparing the two asset classes.
okay.
Yeah. Over the long run, and again, I think Jeff indicated, the actuary, there's a 30-year amortization period, right? And I think there is maybe 20 years or so left based on that. So over long periods of time, bond, you got to earn the coupon. You're going to get 3 to 4%. You don't really expect a lot of capital appreciation in bonds. And then in stocks over time, and I have some more detail in the appendix, which we'll get to, somewhere between 7, 8, maybe 9%. And it can vary year to year dramatically, as you'll see. You can be down 1 or 2%, you can be up 22%. But the focus for a pension plan or any endowment that might exist into perpetuity, very long term, those are the numbers that we more or less look at. Okay?
So did you say we'll get to whether we've been hitting those markers in a long
Oh,
time?
yeah, we'll get there. Yeah, and quite frankly, no, not in this environment, okay? For the last couple of years, with interest rates being so low, there's not many pension plans that have reached 7.5 or 8% in this very short time period.
Do you happen to have 5, 10, 15-year?
I don't have the data prior to our inception, so.
The state is, at no increment, is meeting their 7.5.
No, I can't think of one that, we manage a lot of money, and I actually used to run the state of Rhode Island's pension plan, and, back in that time period, 1999 to 2007, the rates were really, really high, and we did very well, but these last couple of years have been challenging with the Fed keeping rates so low, and so I think that will change, that will turn
But what I'm
around.
saying is, whether you start in 1990, 2000, 2005,
Yeah,
at no point, at least at the state level, have they met 7.5%.
yeah.
So
Yeah,
you wouldn't
I'm
have data on whether we have done that, or
I only have the data on.
when you started?
Yeah, so, but maybe the treasurer could provide that. So unfortunately, it's a very short window that we're looking at tonight.
Excuse me, are there any more of these? Somebody in the audience just asked me if there was any more copies of these. I don't know if there are. I see some audience
brought
members
20.
have them. Okay,
You're
Okay.
out.
Share.
okay, well, I tried, so I just got asked, so thank you.
Okay.
Who would like one?
Did they leave? They were
Yep.
just sitting there.
They left.
Okay.
Okay. Any other questions on the portfolio? Okay, so let's jump to the performance pages. I've done several different time periods just because, so you're on a fiscal year. So page 17, it's somewhat dated because it's June 2016. And again, it's been a tough period for growth stocks during this time period. Certainly haven't knocked the lights out, but most plans are in the same situation that you're in. So if you look at this, so this is your fiscal year, so it's 12 months. The bonds were up 2.1%. Stocks were actually down 3.1%. Again, a lot of that had to do with the growth orientation versus the dividend-paying stocks that did better. So the total account was actually down 2%, 2.2%. Harvard's, for example, was down 2%. I think the state of Rhode Island's was, I think, 0.2 or 3%. So everybody was relatively flat for this fiscal time period. And Jeff had highlighted that was a pretty bad time period. In contrast, 2015, the total return for the portfolio was 7.8%. So growth really worked in 2015. The S&P was up only 5.8%. So 7.8% in 15 versus the S&P's 5.8. This year, we're seeing the mirror image.
I have a question there.
Yep.
You say here that our account went down 2.2%, but in the actuarial report covering the same period, it says minus 3.3.
I don't have the actual report in front of me, and I'm not sure what he used.
Does this include outflows of money?
Um,
It's just the returns. I think there's a difference.
What page is that, Justin? That she's looking at?
Oh,
I couldn't read my mind.
oh, maybe that's the net number then? I'm not sure. It's a little slightly different, but yeah, 3.1, 3.3, that might include fees. This is a
Page
gross
was that?
number.
Well, in the actuarial report, that's page 1.
Oh.
And I'm pretty sure that's the actual investment yield, not the investment return, not including benefits paid or anything like that. So I'm just curious what the
Yeah, I'm
the
not
difference
sure
would be.
where Jeff got that. Fairly close. Good news is no exposure to the international markets. We did not have any emerging or developed market exposure, which were down pretty poorly. As Jean indicated, things have turned around. So if you look down the next page, December 31 numbers, this is June 30th through December 31, 6 months. So it's your first half of the year. Bonds were flat. Stocks are up 8.3%. So again, we're seeing growth come back in favor, and it's actually outpacing, the S&P 500. Okay, and January so far has been a strong month too, so you're probably even higher than that, probably closer to 10%.
I could ask then, the negative 2.2, is that net of fees? Or
Where
is
are
that,
you?
On the,
17.
our account, back on page 17.
For June.
That's a gross number,
Okay.
so I think that the fees are somewhere around 60 or 70 basis points. But for comparison with indices, we always use the gross number.
Right, well, the 3.3, the negative 3.3 is net of fees, so could that 1
Oh, is
percentage
it?
point difference be the difference?
The difference should be higher, because it's 60 to 70%. So
So-
we can touch base with Jeff and see what the difference is.
So in that regard, 3.3, a loss of 3.3% net of fees actually sounds low to you.
Yeah, it probably.
Sounds
should be-
too severe of a loss.
Yeah.
Sounds like a larger loss than what was actually experienced.
Okay.
So then if you jump to 18, again, mirror image, US, we're much more constructive on US stocks. That's why, again, you don't have much in terms of international exposure. There's still much uncertainty. So the total account, because you have 20% to that zero allocation in bonds, the total account is up 6.5% for the first 6 months of the fiscal year. And the annualized return since inception, which is just under 3 years, in March it'll be 3 years, is 5.2. Okay, I'm going to show you some numbers that will look a little bit differently in terms of history, but that's where we are as of December 31. And then, the time periods are very significant and important when you're looking at performance of plans. And so I just read another report that shows on page 19, this is your portfolio as of a calendar year, so December 31. So if you were on a December 31 fiscal year versus a June 30th, you can see this is what your 1 year return would have been for the end of the year. Bonds are up 3.1 versus the benchmarks 2.1. Stocks lagging a little bit behind the S&P, 8.3 versus 12, and the total account up 7.1% for that 12-month period. So the time period really has a pretty significant impact on the returns. But again, your since inception is still just at 5.2%. Okay, So there's been some discussion about the assumed rate of return or required rate of
be-
return.
Excuse
Um,
me, before
so-
we leave page 19.
Yep,
You have total returns, your account, the two numbers are 7.1, 5.2, and then the 2080,
that's a benchmark, so that's a benchmark. So
that's
if-
a benchmark.
Yep, so if
okay.
you were, so we like to put the benchmarks in there so you can see
Okay.
what the returns would have been. And again, some of that has to do, so the most recent time period has a higher weight in the return. So 2016 results matter more than, this is called the time-weighted rate of return, matter more than 2015. So the fact that we had more of a growth orientation versus dividend orientation sort of pulled that down
Yep.
relative to the benchmark.
Okay,
Okay.
thank you.
All right, so, there's a lot of discussion, you're not the only plan out there wondering, gee, should we keep our assumed rate of return, at 7.5%? And I think, over the course of the last year, if you look nationwide, a lot of plans are bringing their assumed rate of return down, maybe a quarter of a basis point. Some of them are at 8, so they're bringing it down to 7.75 or 7.5. But, I think you're pretty much in the ballpark where most plans are. Some might be a little bit lower, but Jeff makes a very good point where, you want to look similar to your peers. You don't want to punish yourself and be punitive and, ruin your funded status by having a very, too low of an interest rate. So I talked a little bit about how the last couple years have been really characterized by a very low interest rate environment. But if you look at history, which I'll ask you to go to the appendix, and I have 3 charts here, and again, they're very different time periods. This is put together by a company called Crandall Pierce, and they aggregate all sorts of historical data. And what I have on page 20 are 10-year returns, so they're annualized 10-year rolling returns, from 1950 to 2016. So that's a 66-year period, pretty long time period. And if you focus your attention on the third row from the top, you can see the portfolio mix of that third row is your portfolio mix, 80% stocks and 20% bonds. And then we have various returns based on that asset allocation. And what they do is they simply use the S&P 500 and U.S. Treasuries as benchmarks to come up with these returns. But if you look at that third row, and about midway in that chart, there's an average return. And it's 9.7%. Does everybody see that? Mm-hmm. That's relatively high. That's relatively healthy, right? But that includes a lot of years where interest rates were very, very high. If you look at the left-hand side, and that's a normalized return over that 66-year period, but you can see on the left-hand side that there's quite a range in your opportunity set, let's say. The worst return during that time period is 1.6. The best return is 17.7. Okay, so again, anything can happen in a very short time period, but if you aggregate that over time, 9.7%. I think that's probably a little generous, given the fact that, we have had low rates and we don't expect them to increase. There were times when the Fed bumped interest rates, by 100 basis points. Right now, they're doing it in increments of 25 basis points, so a quarter of 1%. And we think that's what they're going to do. So we're not going to see very, very high rates, in the very near term. If you go to the next
Actually,
page.
could you, hold on, I'm having trouble understanding. So this is stocks held from 1950 until December 16th, or portfolio?
It's kind of interesting. It's 10-year periods within those since 1950. So April of 1963 to April of 1973 is the 10-year period. January of 1982 to January 1992. There's 680 or whatever 10-year periods in that 66-year time frame. And what Crandall Pierce has done is measured the returns for bonds and for stocks during each of those 600-odd time frames.
And then average them?
And then
On a
averaged it.
10-year
And
basis.
There's so many that were positive and so many that were negative, and on average, it worked out to be this. So you're in an 80-20. I think it says 1% of the time you had a negative return over a 10-year time frame. So you might be pretty confident that staying at 80-20 for the next 10 years will actually make money.
So the rolling
history.
10-year period, so as one year gets added, another one gets dropped.
So,
Stocks did the best,
What's that?
100% stocks.
Right.
Right.
But there's a lot of volatility there.
so what this is,
You have to pay out benefits, and you don't want to
Yeah.
be selling stocks when they're
Yeah.
down.
so if you're looking at the first one, the 1950s or the 1980s or maybe the 90s came in at 19.5, but then say the 70s came in at negative 0.34, and so that just reflects that history.
2000 to 2010 was a tough time for stocks.
So if you're expecting that we're going to hit this 9.7%, you have to expect that the next 60 years is going to look a lot like the last 60 years with the 1950s and the 80s and the 90s, and tech boom and.
Smoothed out, right. Over time really smooths things out. Yeah.
Which is Joan's point, he's saying this is a bit optimistic looking ahead, given that bonds are at much lower levels today.
So yeah, so we're at 9.7, right? If we're looking at that 66-year period. If you go to the next page, page 21, again, I have 10-year rolling returns, but it's only for, it's for a 25-year period, okay? So it's a shorter time period, and it doesn't pull in, the 1950s. And you can see, if we do the same exercise, this is a little bit different because it's 80%, second row is where I'm reading from, 80% stocks, bonds, 10, and cash 10. The average return there is 9.3%. So it's lower than the 9.7, but it's a more recent time period. And again, you can see the range is pretty similar. You have 1.9% was the worst return, 17.2 is the best, and the percentage of times that the market was negative is actually higher. It's 3%. Okay, so this is just one way to look at this.
What's the rationale for leaving cash out of the first table?
It's just the report that was run. There's no particular rationale.
Yeah, this isn't something that you folks generated. This is a purchase from an
Right,
outside
Crandall
vendor.
Pierce aggregates all this
They
data.
publish it, we take it as
Yeah.
published.
Yeah, I don't think there's gonna be a huge difference with that, but, okay. So you can see the returns for those time periods, based on your asset allocation, or, in the 9% range.
And as
And-
every SEC perspective would say, the past is no
Right.
predictor of the future.
Thank you for saying that, that's right. And then what's interesting, I just pulled out another report on page 22 that just shows 1-year returns, okay? So you don't have the benefit of smoothing out and having those rolling 10-year returns. We look at the same allocation, and if you look at the far left, you can see how volatile it could really be. You had an 80% allocation, 20%, 80% to stocks, 20% to fixed income. Over that 24-year period, you could have lost a whopping 34%. That was probably the tech bubble, right?
2008.
Yeah, right, yeah. And then 43, you could have been up 43%, the best return. But again, the average return, even for that time period, is 9.4%. I'm not going to say that you should increase your assumed rate of return to 9%. I think that's unrealistic, given the current period we are at. But I do think the 7.5% is achievable over time. Maybe not this week, maybe not, or maybe not this year, maybe not next year, but over a 20-year period, which is the rest of the amortization period for this plan, that is an achievable return. And in fact, we might make it this year. We're already up 8% for the first half of the year. So let's hope that the second half of the year is positive as well. So I don't think it's an unreasonable expectation. If you want it to be conservative, maybe you notch it down to 7.25, but that's probably all I would do.
Well, I have a chart I'll hand out at some point. I don't know if it's germane here, but the thing you have to understand is that every year you lose when you're trying to hit a benchmark, you have to make up for that. So in the 50s, I gained 10%. If in the 60s I lost 5%, I've got to make 15 in the 70s to get back to where I needed to be,
Right,
roughly.
so that's where the annualized return since inception that we looked at earlier, it's only 5%. Oh, it's a little over 5.2 or 5.3%. That's the number that really should be looked at.
Right, but all of these numbers on these tables are just, don't take account of that. I mean, if you lost that much money in one decade, you would need to make that much more in the next.
Right, this is just to show you what happens over long periods of time. And they're not our numbers, they're just.
No, I know, I'm
numbers.
just.
Right.
I've done a lot of writing about this topic, and it's very difficult to sort of get your head around it, entering into it at first. And
There's no straight line rate of return. There's a lot of volatility.
Right.
right, but
And the
it's important to remember that
volatility costs
if you lose one year, you've got to make even more the next. So saying, oh, we made 7.8% last year is wholly inadequate. if you're going to lose 3% the next year.
Right, you have to
And
look at.
that's the argument the bond salesman will tell you
Yeah.
why you should buy bonds
Well,
instead
I
of
wanted to ask in that
equities,
regard, if,
because they're more straight line.
apart from this fund and this committee, if I were to come to you and say, I have a set amount of money I need to have in 20 years, 30 years, what discount rate would you advise me to use in calculating my personal finances?
The conversation doesn't go that way.
Would
really
you,
doesn't.
would you care to take the fifth?
What do you think? It's more about, so you have a 20-year time frame. Can you risk this money? You know, if this money goes away, do you have other assets to back you up or not? How, you know, what's your risk tolerance?
0. If I have to have that money, I mean, just,
Then we're looking at a mix of assets, not 100% stocks.
right.
And that mix of assets will then determine kind of what we're doing tonight, you know, what you might try to forecast as a rate of return.
Yeah, so it's more, I would say, art than science, is you're trying to, get to that answer, a scientific answer. A lot goes into it. What is your risk tolerance? What is your time horizon? What are your cash flow needs? How long are you gonna live?
Right.
And can you stomach
120.
volatility? What's that?
120.
Okay.
So if a town comes to you and says, we want to hit this number, and you'll say, well, what's your risk? And that'll play into 7.5%. The fact that the town in 20, 30 years can increase taxes to make up for the loss, then you have a little higher tolerance for risk. So you can go up to 7.5%, which you may never hit, but in the end of 20, 30 years, you've got other assets, taxpayers you can take money from. Is that part of the conversation?
It is.
Okay.
Yeah, keep in mind that there's the problems with the pension fund, any pension fund, which our guests have already stated, is you've got to have outflow. And the comparison I see periodically is between a university endowment fund versus a pension fund. For example, Yale's endowment fund does miraculous things most of the time.
Yeah.
But they have the privilege of, if they have a bad year, they don't have to take out of the endowment fund. Our pension fund, you've got to pay the people. And that need for a constant outflow, it gets a little bit difficult. And then the other thing, and it gets, the actuarial reports make assumptions that the entity is going to end and it varies. Sometimes the standard is it's going to end in 30 years, sometimes the standard is it's never going to end, and it changes. So when you make the assumption you're going to be there forever, then you can do all sorts of things arithmetically.
Yeah, I think this amortization is 2037.
Yeah.
Right, but there's,
So-
included in this is the normal cost, which is the percentage that it should be self-sustaining if you're at your appropriate level of funding. So the 30-year, it's not like you're just closing it down. The normal cost should cover that. It's the amortization that
Yeah.
has a goal of 20 or 30 years.
Right. And I would argue, for a public pension plan, you don't need to be 100% funded. You don't need to be. I think, if you're at an 80% range, then it causes all sorts of other political problems too. If you're, very well funded, they're not going to contribute, anymore. So there's, I think the school of thought for most of us that come from the public pension plan world is, if you're at 80% or above, which it looks like you'll get there based on Jeff's actuarial report in 2027. So another 10 years, you'll be at about 80% funded.
And that's sort of a sweet spot
I think
politically, and
Yes, I think so.
because it
Yeah.
keep the employees still feel motivated to contribute.
Right. Yeah, yeah. But you don't want the town necessarily to just say, hey, we're gonna forget the pension plan and,
Which could happen.
Right, exactly. So I
Make
would
the
argue.
goal,
you don't-
walk away.
Right,
Yeah.
right. And then something happens, and so I think 80 to 90 is probably a perfect sweet spot, as you said, to be. But it looks like, based on Jeff's actuarial report, in another 10 years, you'll be at about 80%.
But now we're at about 58, right? We've gone down a little bit.
62, I thought?
I thought,
Yeah.
Well, they revised it and it's gone down to 658 now with new
To
assumptions.
what?
59.9?
Oh, well, he
Using
said
the
that
new
with that, based on the
actuarial
report.
tables.
Yeah, it's on page 4 of his actuarial report.
Yep.
It looks like it's 63% at the beginning of the year, it's 65%. But you're right, there's all sorts of assumptions that will change that. The mortality table will bring that down, and then the compensation issue.
I have a question. Thank you. So when you, I scanned quickly through your assets at the back, and nowhere did I see SPY or IWM, so is it?
Well, he's looking in the growth portfolio. What page are you on?
I just looked at page like 25 area.
Okay, let's see.
So I guess my question was simply, and we don't have to look it up, but my question was simply, if you want to buy SPY, do you go out and buy SPY, or do you replicate that and sample that? And
No,
is
so
it?
SPY is the index for the S&P 500.
Yeah.
and
You just buy the
put it in
ETF.
and
You just buy the
Even on
ETF.
page 15 at the bottom. There are
Okay.
several ETFs there, several different indexes. And the last one, the S&P 500 ETF.
Okay, just a sec, I do want to look at that. That was is that the page with all the bar
Page
graphs?
15, no, page 15 at the bottom of the page. You've got 8,340 units of that fund,
Okay.
worth $235,000.
Oh, okay, those are them there.
That's roughly a spider.
Yep, okay,
Right. So what you were looking at is what we call our model portfolio
okay.
on page 25.
Okay, so this is
That's-
actually the puppies here. So the next question is, what, I get, without doing the math roughly, what percentage of our funds is in indexes? You might have said this earlier, and I apologize if you did.
42.
42% is in indexes, okay. And now the question is how much do you cost us? What is your expense ratio to us?
For investment management, custody, and consulting, because it's not a consultant involved, so we sort of do everything, 70 basis points.
So that's 0.7%? Is that what that means?
0.7%, yep.
Okay, okay.
Yeah, it depends. So our fee schedule is based on a sliding scale. So the larger the plan, you benefit from lower costs.
But you know we're about 0.7%?
Yes.
Annually,
Yep.
okay.
Yep.
Okay, and that includes, so that includes, example, I have SPY, that includes the 0.36% that's built into owning SPY?
Yep.
Or,
Our
that's
fee
what
is-
here I'm getting at now, what do you cost
Our
us?
fee is based on the market value of your portfolio.
Okay.
So the spider counts towards that figure,
But the spider itself has its own expense ratio.
which is not included in our 70 basis points.
So we're paying the 1 or
Oh, it's
1.5%
not
to
that
Spider
high.
or
The
what?
ETF is, I don't know what the.
No, the ETF for spider is 0.36%, expense ratio, annual
Oh,
report expense ratio, net,
And
0.36%.
that is
No.
tacked on or in addition.
Right.
Okay.
Okay, I just wanted to understand what you cost us,
Right.
that's all.
And so the other thing about a pension plan, there's a lot of what I call back office and behind the scenes that also happens, that a lot of B of A doesn't want to do that kind of work. So it's cutting checks to pension, to the participants. So there's a lot of behind the scenes work that goes, so it's not just investment management, it's custody, it's all the administration, individual checks going to beneficiaries.
That's all part of the 0.7%?
So it's roughly 70,000, somewhere around there.
Yeah.
Okay,
The larger the plan goes, the lower it goes. But there's a lot to it, which is why a lot of institutions don't want to do pension plans anymore, because of the back
Yeah.
office.
But you do write the checks to
Yeah.
the retirees?
Yep, yep,
Yeah.
yep.
how long is your contract with them? Is it in perpetuity until it changes? or
We
there's
don't
no-
have a set time period on it. I think most plans, best practice is to probably go out, every 5-7 years or something like that.
To go out for
depending-
bid type of thing?
Yeah, I think so.
Okay,
Yeah, it all depends on, the
so you're kind of
experience and-
entering the middle zone now. You've been here for a couple of years, so you're starting to enter year 3, 4,
Right,
5, yeah.
Yeah, and most folks would look at, in terms of performance, a 3 to 5 year period It's what
Right.
most institutions look at. You don't just look at 1 year, you sort of look at that 3 to 5 year period.
Now, does a company like yours, will you rebid this, or is it kind of known that it's good best practice to jump to a new company like it is accountants? Or would you, in 5 years or 6 years, we rebid this? Would you apply to that, or is it kind of known that you move it on to the next?
No.
Oh, you would, okay. Well, accountants are supposed to rotate, right? You're kind of supposed to rotate it.
It's at Tiverton's.
We would be happy to participate. in
Okay,
future
I just wondered. I
studies.
didn't know if it was best practice for, generally for the municipality to rotate as well through different, okay.
You won't find a manager who'll walk away from any business.
Okay, that's fine.
Yeah.
Thank you.
Yep.
Any other questions from the committee for our guests?
Okay.
No?
Well, thank you for your
Thank you.
time. We spent
Thank
more
you
time
very
than we
much.
anticipated, so thank you for your patience.
Mr. Chairman, before we move on to a different conversation, I just wanted to hand out a chart I made just to illustrate the point I was making. This is data I got from the treasurer. I just went back and got all of the easily accessible actuarial reports from the past few years. We can put that on a table, not just on a table there. That's why I went back 5 years. I would have gone back to 1990 if they were easy to get, but they weren't. What this shows basically, the dark column.
Excuse me, wait till
Oh, I'm
every
sorry.
people gets it.
We need a couple more.
Thank you.
Can't stay on my finger, but it's fixed to everything else. Anyone else?
Okay, go.
Okay, so the dark column is the ending value of our assets. The lighter column is what they would have been had we realized 7.5% investment that year. And we beat that investment number on an annual basis on the 3 middle years, but not on the first year, that was minus 3.2. And this last year, according to this calculation, which isn't perfect, it's estimates from the numbers I had, was 3.4. So what I'm showing here is if you have a year where you lose 3%, you need 15% or so to catch up. And if every 5 years you have every 4 or 5 years you have a year where you lose 3%, you're never ever going to catch it. So what my rough calculation here is that our gap right now from where we should have been if we started the clock in 2012 is $1.1 million, which is a 10.6% gap. And we will now have to hit almost 10% every year for the next 5 to make up for that in the next 5 years. So the 7.5% is fiction. And so if you look at the leap that the actuary gave us today with the changed assumption and the change in the ARC and the liability, that is way optimistic. The idea that we added holiday pay to the final calculation is insane. It should go the other way. What we ought to be doing is lowering our raises, our assumptions of raises, and lowering what's included in the final calculation, because we're never going to get this. And it's eventually, over 30 years, is a lot of time to try to put that in the tax bill so nobody notices, but we're never going to hit those numbers. That's just something to keep in mind when you talk about pensions.
Yeah,
Thank
but and that's true, but and that's why every public pension plan in the country has a makeup called the taxpayers. That's.
Right,
But they're not
This is-
endless.
well, but it's often not. That's not part of the conversation. Even
Oh, no,
even with the investor right in front of us asking him a direct question, he had to stop and think to acknowledge that it is part of the. So that needs to be, the public needs to be better informed that this is an accounting fiction to try to make it seem like this is a reasonable. Because in theory, what you want is you have an investment plan where by the time your employee retires, that employee's essentially off your books, because your investments and what you put in will cover the retirement. But that's not the case at all. So rough calculations as people live longer. You pointed out earlier, Mr. Chairman, that we have almost one retiree for every active member. In a few years, with greater longevities, it's going to be 3. So essentially, the town will be paying for 3 employees for a single position. And that's why private sector companies are going to 401ks or other options. And, because if you, realistically, if you want to make sure you have the money, your discount rate shouldn't be 7.5, it should be more like 3 or 4% that you assume you're going to get, just about covering inflation. So that's what I wanted to share.
Who determines the age at which a retiree is vested? So it went from 20 to 25. Who determined the 20 to 25?
That's the contract is negotiated with the police union.
Okay,
So
so that's
they-
a union.
Yes,
Okay.
that's a negotiated number.
And is that statewide?
No, this plan is just Tiverton.
Okay.
One of, and I'll identify my bias. One of my problems with the Tiverton police pension, and no disrespect to any of the police officers, is that one of the problems with it is it's basically chump change. In the pension world, the amount of money we have is, it's difficult to even get people that will
Manage.
bother with it, frankly.
Would it be different if
The
we had a
do you mean the-
401K?
Do you mean the investor or the employees?
The investment managers, because it's hardly worth their time for the amount of money because it's based on the asset value. So they like really big asset values.
Right, but they seemed pretty happy for the business just then. I don't
Of
think.
course, they're not going to sit here on camera and tell
No,
you
but
that
they-
anything different.
No, but they are
Just,
not unhappy about it, I don't think.
Just a note, if I can. The Portsmouth Fire Department is no longer on pension, and mostly all their employees are not on, they're on 401As.
Yep.
They're out of the pension, and they're not going to go back. The only ones they've had difficult with right now is their police department is very stubborn about it.
Well, most of the Tiverton employees are no longer on a defined benefits. They've been switched over to the 401K when the state went. You will see, if you look at the,
State's still mostly defined benefit.
now, if you look at the financial report that our treasurer gave us, you will see that in the pensions, there's both a state system notation and then a TIAA CREF. And the TIAA CREF part is, I don't know whether it's a 401.
403.
403B,
It's a
A.
403A.
A,
It's not a
B.
B, it's an A. Pretty sure it's an A.
Yeah. Yeah. But they're all a little bit different varieties of the 401K. There's different sections of the tax code, A, B, C. So the rest of the town, except for the DPW, which is a Teamster run account, and then the police is switching over. And that wasn't, the state basically mandated it when there was a big pension overhaul.
They broke that out.
Yeah. Yep, there was a point certain where you were on the defined benefit plan, and then after that date, it was a July 1st, something. After that date, now you're on the 401 whatever. That's why.
Well, if you're talking about the state, it's a mix. So I think more than half is still defined benefit. There's also a defined contribution component.
Yeah. But the cutoff was a date, July 1st.
Right, but
It stopped being defined benefit
But
and started
that's
going.
that's a portion, and my recollection is a relatively small portion of the total pension benefit for employees.
It's still defined benefit, but it's going forward, then it's gonna shift over, so the theory goes.
Not in. It's not gradual. Some of it is, they changed a small percentage into defined contribution, but the biggest part is defined benefit. And I haven't seen any information that the state law phases out the benefit by defined benefit.
No, the defined benefit will only phase out when those employees that are invested in it retire
No, but
and pass away.
Employees are still being invested in defined benefit.
They are. Anyway.
But there is a defined contribution, which
Yeah.
that's how ridiculous the pension issue is that even just a small reform like that was hugely controversial. So you might think that the whole thing has become defined contribution, but it hasn't.
So,
Interesting.
Yeah, I just looked at all that actually, and for the state plan, and my guess is the 403. I'm going to call it the A again, although I know there are Bs, but I think in Rhode Island it's an A. The 403 it maybe is 15% or 20%. The defined contribution is maybe 15 or 20% of the total package, which the bulk of it remains the defined benefit. Anyway, we can talk about that some other time. Could I ask a question to Justin about his chart? So I heard you say something a minute ago and I didn't understand it, but it looks to me like in every year on here, we missed the target. The actual performance missed the target, the theoretical predicted what you'd hope to get return. Is that accurate? Some years almost exactly equal, but they're slightly under. Is that accurate?
Yes.
Well, no, this chart is cumulative. So, for example, if I can bring it up here, in the first year, the investments were down. Again, this is calculated off the numbers I had, so it's close to. We're down 3.2%. The second year, we were up 10%. The third year, we were up almost 16%. The next year, we were up 8%. So if you look at just the percent returns each year, it looks like you're doing pretty well because you only had 2 down years of around 3% and 3 up years of almost over 10%. But when you add that up cumulatively to what you're supposed to be hitting, you're still negative even though you have those good years.
Okay, so in going from 2013 to 2014, that jump in the dark color took a 16% market return year to get that. And maybe that jump is up 4 or 5% or something. Is that accurate? It took 16% to make that little almost equal, the dark. Okay, now I got you. It's a cumulative situation. I got you. Thank you.
okay, and I would like to move on now to the review of the minutes. Does anybody have any changes, updates, comments,
I had a comment
corrections?
that, and correct me if I'm wrong, but in 2A, when Jennifer Ashley asked Mr. DeSisto about cats having the video, I did not hear, and so I'm asking if others heard the way I did. What I heard Mr. DeSisto ask after she asked that question was, does this group have a secretary recording minutes? To which the answer was yes, at which point he then said, well, then there's no problem. And then he did ask, Justin, would you be willing to share it? But in light of not having the session videotaped by Mr. Reeves, who was not here, I don't think that was the cause and effect.
Yeah, well, I mean,
My recollection.
Yeah, you did
in
mention
reality, if it had become an issue, I would have pressed the point because there's no way it isn't legal for anybody who wants to videotape these meetings to do it. I mean, there's no circumstances under which they can't in this particular forum. So, I mean, I just let it drop. But I think he was just trying to get off the topic too, and he essentially said, "Is this available if you want it for minutes?" Yeah, why not? So it was just a way to get off the topic.
But I didn't think it tied into Mr. Reeves not being here. That's my question. That's my difference with this.
So we have 1 point there we might want to discuss.
I don't follow, I didn't hear anything about whether we had a group or whatever. But
Are you advising a change to that?
I would like to just take out, in light of not having the session videotaped, I didn't think that was part of what he said, but that's my recollection, my notes.
That's not what I wrote, but
That's
I
what
will.
and what she wrote is what I understood. That's,
I just heard him ask if someone was taking minutes, which
Right.
isn't in
Yeah.
here.
Which isn't in here. And he did ask that. Is there a person
I
here
can
taking?
change it to that if that makes
I guess that was his trying to meet requirements, making sure that there was minutes being taken, even though we didn't
So
have the video.
I would ask that it be changed, you can put in light of the Budget Committee having a secretary and Mr. Katz's agreement, he said it's allowable, that I would feel better.
Yeah. But that's fine. We should make the change and move on.
I have a point.
Yeah.
In 2B, toward the bottom of 2B, it says, where is it here? I just had it and scrolled. Oh, I'm sorry, 2C. It says, J. Katz and J. Karen continue requests as to how the student number is calculated. That was actually the maintenance of effort, I believe.
Right.
Was calculated, first of all. And so I would like to see that, to how the maintenance of effort is calculated rather than student number. We were discussing, there's two different ways the maintenance of effort could be occurred. One was through an absolute thing, and one was through an absolute calculation, and one was through that. I think that we were discussing in general maintenance of effort, and then, let me just finish, and then we can discuss it further if we need to. The last sentence says, Tony reports he will check case law and ride regs among others. When we were done, the solicitor said, okay, so I'm on the hook for, and he was going to prepare something about the maintenance of effort calculation. And I remember having exchanged him, yes, thank you, would you please write that up? So I think it goes one step further. He was gonna look into case law for that, and he was also gonna provide us with, a write-up about it. And I distinctly remember that conversation.
Yep.
Okay, so I'd like that last sentence, Tony reports he will check case law and ride regs among others, and provide a synopsis or something like that to, an opinion to the committee. Above that, where you say Katz continue to request as to how the student number is calculated, if you'd like, maybe we just add as to how the maintenance of effort student number is calculated. Or put the student number in parentheses, I don't, but just somewhere add maintenance of effort in that sentence, right around the, thank you.
Okay, thank you.
Anything else?
Yes, in a previous bullet 2B, I'd like toward the end to reflect the solicitor's affirmation that none of his advice regarding contracts and negotiation precluded our taking any kind of votes at all. So it was just advice, and it does not make any kind of votes out of order or anything to that effect.
I do remember that.
We're gonna have to start recording these.
We are.
Well,
It is recorded.
I'm not comfortable going by what people are saying. That's what the vote's for. But, I need something definitive about what was done or said, that's all.
Well, I do have the video. If it's a point of contention, I can make that
It won't
available.
be a point of contention, because I'll be the only one who votes against it.
Yep. And we are recording it now, and we were recording it.
Right, we have a record.
And for the record, when I asked Mr. Katz, would he provide me with copies, he immediately said, yes, he would.
After bribing him for some money. And just a typo on number 12, Hollenbach has 2 L's.
Thank you, Justin.
Did you notice?
And then before I ask for a motion, the other thing
And CH, right?
I want to reference is that the minutes are not court reporting. So they're not meant to be perfect in every regard. They want to capture the main thing. And then one of the advantages of having things videoed is that if it's really an important point, we have an actual record we can go to. So with that, I would like a motion to accept the minutes as amended.
I'll make that motion to accept the minutes with the amendments just discussed.
Second? Second. We have a motion and a second. Any discussion? Hearing none, all in favor? Aye. Opposed? One no. Abstentions? Mrs. Cook, did I see you vote no?
No, I moved this.
Oh, okay, just checking,
No, I took it.
just checking.
Oh, my God.
Okay. Next item, I had put on a preliminary vote on the fiscal 2017-18 debt service. And I think I overstated the situation by calling it a preliminary vote. I really should have said that we have understanding that if we look at the exhibits that Madam Treasurer handed out last time, and what I had labeled as Exhibit 1, and that was the sheet that had all the, on the left side, TIF bond, Fort Barton, and then came all the way over to a total debt service. That I just wanted to make sure that we all had the understanding that the debt service is going to be $3,859,666 plus the interest rate for the not the interest rate, but the interest amount of $514,500. All of that being dependent on Madam Treasurer's assumption that we could get the school bond floated for 4%. So that's, I wanted to get that general understanding that we all followed that. And it will really depend on what the interest rate turns out to be before we have the final number, so that there's no need for a vote.
And it's also on the Exhibit 1 that Denise handed out, that $3,859,000 was gross.
Yeah. it's
That's the
always
total
gross.
commitment,
Yep.
Including state aid and town
Yeah.
sources.
Yeah, the payments are always gross, then the state aids come back on the revenue side of the calculation. So am I understanding right? Does everybody see that that's where we're headed? There's really not much we can do about it. In fact, there's absolutely nothing we can do about it because the voters voted on it. And about the only variable at this moment is the interest rate and some timing things. Okay. So no vote required. At Mrs. Cook's request, I added item 5, request waiver. I talked to Karen Mellon, who is the director of the Office of Library and Information Services, who directed me to their website, where there indeed is a process for a waiver request. And it boils down to one of the criteria of the waiver is that it has to be, any reduction of the maintenance of effort has to be across the board. And I can send everybody the link to the page on their website. But if the total town budget is cut, say 1%, just for discussion's sake, then with the waiver request, the maintenance of effort can also be cut 1%.
I think that's overstating the specificity of the instructions here, which
Well,
I just handed out.
I'm also going by the phone conversation that I had with the director.
The director of
the Office of Library and Information Services. So, but the last point being is that the organization that has to apply for the waiver is the library. So, because we as a budget committee have no standing in terms of changing the level of the budget. If you look at the town charter. So there is a waiver out there, and it may have some applicability.
So the director is the one who told you that it has to be the library that has to apply?
Yep. Yep.
I love how it goes from the law to the regulations to what somebody says over the phone, because the regulations are very different. For example, it says you would have to show that the decrease in funding of library services is comparable to decreases of funding of other municipal services, not all other municipal. So if that's one of the areas where you realize you'll do the least damage to your community, I don't think they're going to say, no, you have to damage your community in order to get this waiver.
Well, for all I know, there's case law that expands that other municipal things. I have requested a guidance from the town solicitor and have not received any yet. But the waiver is out there. I still don't think that the budget committee has standing to apply for it, but that remains to be seen.
Somewhere I was under the impression that the town council had to request the waiver, not the budget committee. But
Could be the
I would like to,
council.
I'm gonna make a motion to table this until we get some definitive guidance from somebody, a guest, be it our council, be it somebody from library services.
Well, I
because
think the
there's a lot of,
town solicitor is the one that's got to guide this.
that's fine.
What I was going to say was that they got a waiver in 2008.
Can you kindly state who you are, please?
Madeline Odell,
Thank you.
they got a waiver in 2008. So that would be a guideline you could go by. What did they do in 2008? And our solicitor was not here then, so maybe somebody should tell him that. If that's where you think you gotta go, you know what I'm saying? It was done before, that's,
Yep.
so I don't know how it was done, but that certainly was recent. I mean, it was only 8 years ago, so.
8 years ago. Okay, I have a motion.
Before we table it, I'd just like to clarify what I just heard from our chairman. So did I hear you say a minute ago, Mr. Chairman, that you had reached out to the solicitor for guidance on how to handle
Yes,
this topic?
and have not.
You haven't received it, but you have reached out.
Yes.
I just want the minutes to reflect that, that's
Yep.
all.
Yep.
Thank you.
Yep. So I have a motion to table.
I second the motion.
Any further discussion?
Just for Robert's rules, tabling, there's a couple different mechanisms. This was a motion to table. Some of the motions don't let you bring it back that easily, and some do, and I don't recall my Robert's rules that well. I'm a little out of shape. If we motion to table, is the understanding of this committee that we can bring it back? I mean, do we need a motion to table, or we just move on? Because sometimes these things are hard to bring back to discussion once you table
I'll
them.
put that in the motion, that for, you know.
Yep.
Can we bring it back within a?
It's a temporary tabling until we get the advice here and we bring it back up on the.
Yeah.
It's not to throw this thing away. It's to get
Okay,
information.
but do we need a vote to bring it back, or can we just get it back on the agenda the night that the solicitor
That I don't
speaks?
know.
I just
No, I
don't want to
think-
have to go through a vote
I think.
to bring it back, that's all.
When, in a loose interpretation of putting it on the table, means you put it on the table and you can bring it back at a later time without a vote.
Okay, that's fine.
That was always
Yeah.
my impression
Okay.
of it. but
Yeah.
so that
Yeah.
we're all
I wonder
understand
then-
that that's-
Why don't we just
Yeah,
continue
what's
it
the-
pending
what's the
desist
purpose
us?
of- I mean, you brought up the debt service, it's not been
Because I-
tabled. I mean,
I
we're
have-
just,
Continue this topic to a future meeting.
so should
do
we do
that.
that on every topic we raised? I mean, should we do that on investments and debt
No.
and police pensions?
No,
and-
because we've got to end some stuff. You can't continue everything, although some bodies do a pretty
Well,
good job of that.
so in other words, we're saying we can table it and probably bring it back whenever we want. So then why not just move on, and if nobody puts it on the agenda, it doesn't come back?
We'll throw it away and we'll just re-bring it up whenever we need to.
No, no, no.
Why
let's.
don't we just do a
wha-
motion
no.
to continue it at another time? when we
Okay.
have The information we need.
Whatever.
Is there,
Oh,
now,
I'm going to vote against.
let me go back.
You're going to vote against.
Mr. Souza made a motion, I was following through. Mr. Souza has retracted the motion, as I understand it, and opted to continue it.
I'll word it any way.
So his
The
motion
intent
is gone.
The intent is to bring it back on the table
So
when we have some
now,
advice.
now I'll ask for a motion to continue this until we have further input from the town solicitor.
I'll make a motion to continue this when we hear from the solicitor and hope, for possible next meeting. I'd like it on the agenda so it doesn't get lost.
It won't get lost.
And what if the solicitor doesn't reply?
I'd like it on the agenda if we don't have an
I'll haunt
answer.
him until he replies.
Keep this clean, I'll withdraw the motion.
Just move on in the
And the
meeting?
second,
Yes,
person seconded,
yep,
agrees.
you did that, and now we have Mrs. Cook asking for a continuation. Does anybody want to? Okay.
Withdraw?
Okay, so
No,
we're
I
just
know,
going
I
to
know.
continue it.
What's next on the agenda?
Next on the agenda is correspondence or information document presentation, which you all got when you came to your positions. There was a town clerk budget. There was a town treasurer's budget, and you all should have copies of the audit report. And you also should have a copy of the school committee's preliminary budget.
Where was all this?
Should have been at your place.
I don't have any of that.
And the annual financial report?
All I have here is, the only thing I have here is the police pension plan portfolio review.
So there was this packet.
Don't have any of that.
You have one of these, Jay.
Yeah, I got one of them.
Okay. But John doesn't.
John didn't, there
Is
must
there
not
I'll
have
get
been,
one after. I'll
must
get
not have
one
been a
after.
place setting for you.
Yep, we'll get
I'm not
those.
here.
Okay,
I'll pick one up after the meeting.
yep, we can equip you. Okay, town facility visit, we're scheduled.
Before we move on from the correspondence,
Yep.
I just want to ask anybody at the table. I know Justin handed out, I think, 2 items, and I don't know if you just mentioned them, but he handed out a chart
Yep,
and in the meeting, and he handed out this OLS waiver form to everybody.
yep.
Was there anything else that anybody else handed out in the meeting as a member of the body?
No.
Okay, I just want to make sure that they're noted in the minutes and they're somehow attached to the, to the other things that were on the table when we all
Yeah.
walked in.
The other correspondence or information that was handed out was the supplemental page from the actuary and then the bound copy.
Right, that was the official stuff, but
Yep.
I'm talking about things just from committee members
Yep.
who did a little homework on the side, okay.
Yep.
So I just want to make sure these are somehow attached. And I also wanted to ask the question to Deb. This one is beautiful. How is this one going to get, Pete, is it going to, how,
That is not gonna go on the secretary.
okay, I'm not asking for that, but at the end of the day, you have a record. How is this going to, is this just a big pile of stuff that goes in Nancy's office?
It's gonna go in here.
Okay, and eventually at the end of the year, it all goes in there? Okay,
Yes.
as long as it's somewhere. Okay,
This
just want to
looks
make
to-
sure.
This looks to be the audited financial report that's on the website already.
Correct.
Yes.
No, I'm talking about this one that we just got.
Jeff, there's a attachment on the Secretary of State website where you just click, there's attachment, so it's noted that there is an attachment. That's not, I'm not uploading that.
I'm not asking you to, I just want to make
But it's
sure.
identified.
Yeah, it's identified.
So you'll
identified.
punch holes in it and stick it in there or something? Okay, that's fine. I just want to make sure that everything's kept. I just wanted to know what that mechanism was. Thank you.
Okay, so we're scheduled to meet at the fire station this coming Saturday at 9 a.m. North Fire Station, also known as 85 Main Road. And the fire chief has asked me to get a count for how many people that will be there. No hors
Donuts?
d'oeuvres.
Donuts?
Pancakes.
I'll be there.
1, 2, 3, 4, 5, 6, 7, 8, 9.
Which fire station?
North
The
Tiverton.
North
North.
Tiverton.
North Tiverton.
The main one, North Tiverton,
It's right near you.
9 o'clock. So I'll tell him
No,
9 or
no,
10.
Donuts to your house.
9. Okay, then the following week, on the 21st, at 9 a.m., we're to meet at the police station, and Chief Blakely has also asked for a count. So how many people will be going to the police? 1, 2, 3. Looks like 9 to 10 is a good
If we
number.
find out we can't make it, there are no consequences.
Just an extra donut.
Well, I don't know.
You get a ticket.
You don't know. You know. The word may go out, find us a license plate. Okay. Any other business? Thank you for the count on that. The other thing, let me, for the new members of the committee, let me say, particularly for the fire facility visit, wear sturdy shoes and warm clothes, because the facilities aren't particularly well heated, to put it mildly.
That's an understatement.
Anybody have any other thing they want to bring up?
Didn't it say 3 sites? Or just the
Fire,
one?
the fire, yes,
No,
but started in North Tiverton.
yeah. Yep,
One
I might
station
not be
each
able to
time.
stay the whole time for all 3. but
yeah.
do what I can.
That's understandable, yeah. Because we don't know how fast it'll go but the only reason he wants a count is I'm assuming he has some handouts. I hear no other.
Motion to adjourn?
I hear a motion to adjourn. Second. And a second, all in favor?
Aye.
Aye. We're adjourned at